Hey everyone, it is Evan here from the Trade Risk on Tuesday, December 11th, here with a midweek market recap video. We're going to cover all of the major markets and the current market environment. So I got a bit of a head start on today's video. So the snapshot I took on our market technicals page is about 5 or 10 minutes before the market close. So some of these numbers might be a bit off of their actual closing values, but I think all in all, it should be pretty similar. So when we look here at the performance today, it was essentially a flat day in the market, but that was a letdown given the fact that we did have kind of an open gap higher potential follow through day. That was sort of a letdown. We'll talk about that at the when we look at the charts in just a moment. Take a look at the 5-day changes here. Pretty horrible numbers, 5% right across the board, and that's certainly from last week's basically straight line drop, but some pretty ugly action out there. We're below all moving averages, in between or still above last week's lows. When we look here at the individual sectors, again, look at the lows down here on the financials and the Dow transports, almost 10% to the downside over the past 5 days. Now I know 5 days is just a small snippet. It doesn't have any magical weighting or meaning. It's just to give us some general context about what's gone on since the last market update. But generally speaking here, these are some pretty horrible numbers out here for performance-wise on some very important sectors. Utilities are the only things green over the past 5 days. And of course, when we look at some of the major markets, we have volatility, which is up 30%, I think from a 16 handle to above a 20 handle where it sits right now. So some real ugly action in the very short term, but let's take a look at the charts. Let's see what it all means. Let's put some levels to it. We'll start off with our weekly time frame S&P 500 chart. This is the cash market. And you can see here, remarkably though, we are still up here on the week, 36 bips to the upside, 0.34%. And you can see we do have a pretty sizable tail on this week's candle so far. It is, of course, only Tuesday, but we still like to keep an eye on what the big picture's looking like and what the weekly chart is telling us. And we are trying to cling on to this range here that we have been in since the start to mid-October of this year. We've been chopping around pretty violently, really just ping-ponging in between about a, about a 10, actually no, not even, about a 7% range from low to high here in the S&P 500. And now we can see we're testing that. We briefly were undercutting it yesterday, had a little bit of some fear out there, a little bit of panic as we started to break through some support levels yesterday. But then we did see a turnaround in the market. We did start to get that follow through today, but of course not really materializing as good as the bulls may have wanted it. But as it stands now, structurally, we are trying to hang on and defend this support here in this sideways range. We are still below this major key trend line, so volatility expansion below a key trajectory. We are also still having the MACD making new lows here on the weekly chart, so it is still a vulnerable market here, market structure, as we look at the big picture on the weekly time frame. Lows down here, 25.33. That's the lows from year to date. Not sure we'll get down there and test them this year, but that would be the next big target that we'd be looking for if we started to lose this general area, this support area where we've been in around 26.25 or so. So if we go down to the daily chart now and we go to the S&P 5, the SPY ETF, we can switch it over here, and you can see just how fast this drop was from last week, or really from Monday. We had the gap open, and then it was basically just an open and then drop all week last week. And then this week, when we came in yesterday, we had a relatively flat open, but then we got a probe all the way down here. We were down let's see, about 2 or 3%, a little over 2% at the lows of yesterday. We got as low as 258.62. We took out the lows from back here on the 29th of October, but take a look at the reversal. Take a look at pretty much the hammer candle that we got there. I know it's not a textbook hammer, but we got almost an entire reversal there, washing out all of the supply in here, and washing out all of the, really it's the longs that are capitulating over here, and aggressive shorts that are trying to get in here on a new breakdown low. We reversed that, and then we started the day off with an encouraging gap higher that was, at least initially saying, hey, maybe we got some confirmation here on this reversal, but that didn't really hold itself. We did close flat on the session, essentially up 4 pennies here in the SPY ETF, but still a pretty good give back here. So it was a disappointing follow-up day for the bulls. However, we are still holding on to this 263 area and the bulk of yesterday's reversal. So I think going forward, 263 or so, or 262 to 263, this was our general line in the sand here. I'm still putting a good amount of weight there. I'd like to see the market continue to consolidate above 262. I would give it a pass here, even with today's action, if it can continue to hold above 262. But if it starts to lose that, particularly if it starts to take out Monday's lows, that I think is your new sort of line in the sand. If you're a bull, if you're trading against this market, if you are looking for a reversal here, you do have a good opportunity to have a nice tight risk if you're using this as your stop and you're looking for a move back up into the 270 area, 270s, into the middle of this range. That makes sense to me, but all in all, it really just depends where you live. There's a lot of movement here in markets. I think we've all clearly seen that we're getting a lot of two-way trading here throughout the intraday session. Good for day traders, not so good for longer-term overnight holds because gap risk is high. There's a lot of just noisy swings out there. And pretty much, if we look back the past 3 months or so, we're directionless. We're sideways within the context of an immediate sort of breakdown. So really you have kind of this downtrend that is trying to form here on the longer term chart with sideways over the past 3 weeks or 3 months. So it's been quite inconsistent there and quite frustrating if you're trying to take advantage of an intermediate term time frame, unless you're really tactical and picking your spots very carefully. So that is what the landscape looks like here for the S&P 500. We got some important sessions ahead of us towards the remainder of this week. The close of this week will be important. Let's see if Monday's lows can hold. So far, the bulls are staging a reversal. It still needs confirmation. It's still very short term, but we really do need to see if it can hold above this 262. If it starts to fall below there, start to get a close below there, and especially below Monday's lows, all bets are off. Be tightening up that risk and bracing for what could be another leg to the downside. So that is the SPY S&P 500. Last note on it, we still do have this positive divergence brewing here on the momentum oscillator. Look at a MACD chart and take a look at the series of higher lows that are continuing to get printed as we come down and continue to retest this 263 area. So also, that's encouraging there. But as we said on the weekly chart, we have MACD lows being made. On the daily chart, we have positive divergence. So again, time frame very important. Let's go to some of the other major averages here. Qs, which again is trying to act a little bit better here than the rest. It did not eclipse or take out the prior lows here back from the 20th of November. Now, it was sort of a different footing here. It's just sort of a different path it took, because in November, it did take out these October lows, whereas many of the major averages didn't. And now it rallied back up, came back down, and now it's holding above these November lows. So slightly different action there, but mildly constructive. A little bit of relative strength brewing here in the Qs as it didn't make those new lows. 160 is held. Let's see if this can act as the leadership group. It did close a little more green today, but still gave up most of the market open, the gap open. So let's pay attention to the Qs, see if they can help lead this market higher into the end of the year, or at least just for the next week or so. IWM, this is the sore spot right now. This is the Russell 2000, which is closing at new lows here within the context of the past multiple months. We got a close down here in red territory today at 143.41. That was lower than yesterday's close. Notice we still have the tail down here. We still have a reversal that was staged yesterday, but we're still below kind of this 144, 145 area. This is the prior pivots back here in October and mid-November. So IWM would really like to see this back above 146, ideally even 147, 148 to get more confidence there, to put in some more structural support. The longer we hold below here, below November's lows, the worse or the more likely that the sellers can continue to hold in control here and trend this market to the downside. So that's the Russell, little bit or clear lagger on the downside. Qs, clear relative strength winner right now, and S&P 500 somewhat in the middle. So lot going on there, but it really does depend on time frame and you know, how active you're looking to be right now. TLT, this continues to remain resilient up here, 40 bips to the upside, making a little bit of upside progress, but more or less a pretty stagnant range so far this week. We reclaimed this very important long-term 117 area last week with the nice kind of rotation into bonds here, 2.67% to the upside last week. We're holding it so far. That's constructive action for bond bulls. The longer we can hold above 117, the better, you know, the better odds it looks of kind of reversing higher back into this range. A little bit of digestion here, maybe a higher low to get put in would be totally reasonable, and you know, pretty bullish action. We have this trend line that maybe will continue to extend here and be the price, be the point at which price does find some support, but we will see as that continues. 117 or so, the lows from last Tuesday is what I'd be paying attention to. Next up, go to oil. Oil here was positive today. It was down yesterday, so it's down 1.5% on the week so far, printing an inside week. That means we're within last week's highs and lows, and range so far has been pretty tight. We're still, you know, kind of at the bottom of the apocalypse that has happened here in oil over the past couple of months, and you can see we're just mostly moving sideways, pretty lackluster. MACD is trying to, you know, rise here and you know, move back up into, or close, you know, trying to get back up to at least flat territory, but so far there's still plenty of work to do. We're waiting to see if this turns into a bear flag, which would spell another kind of ugly leg lower in oil, or if this can in fact you know, stabilize us and rotate higher above some of these recent prices. Yet to be seen right now, but we are coiling, so something to pay attention to. And speaking of coiling, natural gas here, still higher lows, lower highs in this pattern. Had this huge move to the upside back in November, and now it is just working itself off through time. So a pretty bullish looking what could be a continuation pattern at this time. However, it is yet to be seen. It was down 3% today, closing near the lows. So maybe you get some aggressive shorts in there that are looking for these higher lows, or these the higher lows to get taken out and broken to the downside, and then we see a more meaningful retracement. Certainly could happen, but for now I'd just be waiting and seeing to see if that does in fact happen. I'm looking at this as a potential trade, but so far you know, nothing as of interest right now. So that oh, and finally, actually metals, we missed metals. So if we go to GLD here, you can see on the week down slightly, 47 basis points. We're inside week so far. That means we're in within the highs and lows of last week, and you can see we're just kind of holding up in this short-term trend higher. This could turn into a massive bear flag. This would be pretty ugly here, a multi-month kind of bear flag structurally from the multi-month leg that we saw starting in April to the downside. But so far, at least in the short term, bulls are trying to keep this trend alive, and MACD trying to get back into positive territory there on the weekly chart. Daily chart here, again, 115 or so. That's still my kind of line in the sand on the downside. If we started to lose that, then I would be cautious. Otherwise, let's see if we can continue to, you know, kind of grind higher here in GLD. Doesn't interest me for a trade one way or the other. Silver still moving sideways in this channel here, $13 to $14. That's your range. We've been in it for the past 3.5, 4 months. So let's see if we can get a breakout from there. Doesn't look like it'll be anytime soon. But you know, that could change pretty quickly. So that is the recap for this Tuesday, the 11th. Thanks so much as always for tuning in and watching. If you like the videos, you can subscribe on YouTube, follow us on the blog at The Trade Risk, and every Tuesday and Friday is when we're doing these videos just like this for the market recaps. So thanks so much, and catch you in the next video update.